You talk about the great myth of tax deferral when it comes to retirement planning. Can you explain?
Sure. We have been convinced that when we're young and we want to put money into a 401k or IRA, it's going to be terrific because you don't pay any tax, it all gets deferred, and of course we're going to be in much lower tax brackets when we retire. So, we're not. The problem is we are in fairly high tax brackets when we retire. First of all, tax rates have gone up. Second of all, we've lost our deductions. We may not have a mortgage anymore. We may not have children dependencies anymore. We may need the income that perhaps we were giving to charity, although we stay charitable. We may have to cut down a bit. So there are many, many deductions that we lose. And we can be in a very, very high tax bracket. And yet, we have, starting at age 20 to 30, when we get our first jobs, we cherish this deferral. Well, be careful, right? Be careful what you wish for because you might get it. Starting around 45 or 50, you really want to take a look because it's a very easy calculation to have any accountant. You can do a calculator online. You can have your financial planner say, when I must take the money out, either because I am retiring and I need the money to live on, or because I'm 70 and a half and the government requires me to take it out. Either way, how much tax am I likely to be paying for the rest of my life? You may be shocked. And if you are, and you want to really manage some of that tax, number one, please realize that it's going to come out of your income, and you may not have as much in retirement as you think. Number two, consider some of the strategies for getting it out early, paying the tax early, and keeping it tax-free for the rest of your life.
So can we do those strategies real quickly? Is it easy? Are there things that they should do?
Sure. I mean, one of the things is you can convert to a Roth IRA if you have the dollars to pay the tax.
Prepays the tax.
Prepay the tax.
Right.
A second thing that you can do is you can buy a new kind of annuity that the government just created in 2014. They made the regs in 2016, so it's brand new. And that's called the QLAC, Qualified Longevity Annuity Contract, where a couple can get about $250,000 out of the RMD, so they don't have to take it out, and an individual $125,000. And you can also, if you are insurable, you can use some very, very powerful insurance products where the insurance company will actually prepay the tax for you. Basically, they're loaning you the money for the tax, and you're getting them to be paid back from the death benefit. So if you don't want to pay it from your pocket, like with a Roth, you can pay it from your kids' inheritance if you would like. There are plenty of ways that you can pre-plan this and not get a surprise as to how taxed you really are.
All right, but always planning takes. It requires some planning and some expertise.
No question.
Thank you. If you like what you just saw, we have many more videos with Adriane Berg and with more experts at bottomlineinc.com. And do me a favor, do that social thing, share it, tell your friends, tell your family, come to bottomlineinc.com.